Tesla just delivered a record 480,000 vehicles, so why did the stock fall 14.5% right afterward? At first, that doesn't add up. Deliveries hit a record, revenue rose 26%, and on the surface, that sounds like good news. But Wall Street wasn't really asking how many cars Tesla could sell. It was asking two harder questions. How much money is Tesla making from the business it has today? And how long will investors have to wait for the AI business they're already paying for to produce real profits? Let's start with the business Tesla has today. Tesla sold more cars, but operating income fell 57%. Its operating margin dropped to just 1.4%. Free cash flow turned negative by 1.1 billion, while capital spending jumped to 5.8 billion. Put simply, Tesla sold more cars, made less money, and spent a lot more cash. That's the first problem. The bigger one is that Tesla isn't valued like a traditional car company. A large part of its valuation depends on what comes next, especially robotaxi, and China gives us a useful clue as to why Tesla needs that future so badly. Look at the Chinese EV market. Competition is brutal. New models come out constantly, prices move fast, and even the biggest players have to fight hard to protect their margins. Selling more cars is great, but the tougher the car business gets, the more valuable it becomes to own something that can keep making money after the car is sold. That's where robotaxi comes in. Think of it as an Uber-like network without drivers. If Tesla can make that work at scale, the economics of the business change completely. The old model is simple. Sell one car, make one sale. With robotaxi, that same car could generate thousands of rides over time, while Tesla keeps making money from software, services, and the transportation network itself. That's a much bigger opportunity, and it helps explain why investors are willing to pay such a high price for Tesla today. But there's still a problem. Tesla has to prove that robotaxi can actually scale. The company says paying customers have now logged about 2.5 million robotaxi miles. That's real progress. But the service is still limited, and Tesla has become more cautious about how quickly it can expand. This is where the valuation gets difficult. If investors are paying today for profits that may not arrive for years, every delay matters. The longer those profits take to show up, the less they're worth today. And every extra $1 billion Tesla has to spend before the business reaches scale makes the current price harder to justify. And this isn't just a Tesla question. It's a useful way to think about almost any company selling investors an AI-powered future. Don't just ask how fast it's growing. Ask when it actually starts making money and how much cash the company has to burn before it gets there. Those two questions can completely change the way a growth story looks. So Tesla stock didn't fall because people suddenly stopped buying its cars. The cars actually sold extremely well. The real issue sits underneath that record number. Record car sales no longer answer the question investors care about most. Can Tesla turn robotaxi and AI into a huge profitable business? And how long will that take? That's what the market is trying to price. It's also why Tesla's biggest opportunity is one of its biggest risks. So what is Tesla today? A car company with an AI story, or an AI company that happens to sell a lot of cars? Let me know what you think. And if you like business stories that make complicated numbers easier to understand, follow for the next one.